Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Good morning, everybody. Well, it's been an interesting year, to say the very least, as far as the foreign exchange markets are concerned, but also, of course, the macroeconomic picture. And we'll be looking at both of those in my presentation and then turning our attention to what the technical outlook looks like and what 2021 has taught us. So I'm hoping that over the course of the next hour, this is a slightly elongated session, that you will get a good idea of what our thoughts are on 2021 as a whole and how we view 2022 panning out. So without further ado, I'm going to throw us straight into the content. And if we move on to the next slide, please. This is just a quick plug for a document that hopefully will have appeared in your inboxes about the 2022 year ahead document that was produced by our strategy team. And in particular, the 5 podcasts that were recorded around that. There's some really, really useful material in those podcasts. I appear on the A World of Shortages podcast, and there are links within this slide deck to those particular podcasts. So when we send them out, I would encourage you to listen in. It won't take up a tremendous amount of your time, and I think there's a lot of useful information there. But we see these key themes in the titles as the 5 themes for 2022. So please do take your time to look at these topics, and the document itself is 158 pages long, but there are summary documents that are much shorter, around 25 pages long, and you can find all of that on the strategy and sales portal within our website. So I again encourage you to take a look at the 2022 year ahead. Now moving on to the next slide, and it feels a bit like deja vu, I'm afraid, with regard to what we're seeing from COVID. So if you look back to last year, we saw a significant rise around Christmas time. So December, the numbers were all rising with regard to the COVID infection rates, and this particular slide just shows the number of daily COVID tests that are positive. You can see that there are some outliers here. Germany and the US seem to be showing steep increases in the number of tests that are being returned positive, whereas there's still much lower numbers of tests that are being returned positive in France and the UK. Now, I would stress that with regard to the UK, a lot of that is down to the fact that there are simply far more tests being conducted or being mailed out. So consequently, we are seeing a bit of a skew with regard to this particular ratio, because if you look at the overall number of tests that are returning positive, then there are similar numbers in the UK and Germany. So this is just a case that the UK is testing more, but potentially finding a lower incident of positive returns. Now, the COVID case numbers are rising across Europe, and that has led to the suggestion that we're going to see new lockdowns being implemented. In some cases, that's already happened. In places like Austria and Germany, there are new restrictions, and for those that are unvaccinated, they are very stringent restrictions with regard to movement. So you're not allowed to visit a lot of things that are deemed discretionary, and you're only allowed to leave the house for reasons of work or essential shopping. The lockdowns and restrictions across Europe are not being replicated thus far in the US or the UK, although there are reports this morning the UK could be moving to a plan B where we're heading towards home working, and indeed restrictions with regard to indoor venues. We'll wait and see whether that is indeed the case as far as the UK is concerned. But as I say, that does have a similar ring to it versus what we were seeing back in 2020. So at the back end of 2020, we saw those restrictions being reintroduced. And in fact, those restrictions lasted until the back end of the first quarter of 2021. So there are fears for business in the UK and beyond that what we might be seeing is going to be significantly detrimental to the economic outlook for 2022. In the same way as we started 2021 quite poorly, but then we caught up a lot of that economic momentum quickly as far as the UK's economic recovery is concerned. So there's concerns about that. There's concerns that this new Omicron variant could spread throughout the world quickly because it's seen to be more transmissible. We're not sure about what the data is on how severe the symptoms are. At the moment, those people that are catching it have had relatively mild symptoms, but I think it's really too early to say whether or not this is the virus mutating, so it's more highly transmissible but much less serious in terms of the health conditions it creates. And then, of course, there's a question mark about Asia, which, with the exception, of course, of China, has lagged behind in terms of levels of vaccination and economic recovery. What will this mean for Asia? Because Asia is an increasingly important element with regard to the supply chain, and it's where we've been seeing a lot of the problems, the disruptions with regard to the supply chain over the course of the last sort of 5 or 6 months. So I think we're keeping an eye on that. And that leads me neatly on to the next slide, which is talking about the risks for corporates. So as I say, this next slide shows issues around the risks that corporates are facing. So supply chain disruption has led to significant increases in pricing, both of raw materials and also shipping goods. It's definitely led to an increase in energy prices as well. And this is not just for the UK, this is all around the globe. But we've seen labour market pressures potentially more severe in the UK than we've seen in other parts of the world, and certainly in other parts of Europe, with job vacancies at record highs. Remember where we began 2021 as well, where vacancies were at a very low level versus the historical average over recent years, and yet we've pinged to record highs. And when we get more data from the employment numbers that are coming over the next week or so, I'd expect to see those job vacancy numbers continuing to rise. So labour supply is a severe problem for 2022, much more so than it was in 2021. And another issue that I think corporates are battling with is the levels of leverage that they've been experiencing. They had to, over the course of 2020 and throughout the early part of 2021, take on additional borrowing in order to keep the lights on. And that was because of the restrictions that were still in situ as far as the UK economy is concerned. I mean, we haven't even had a full 6 months where those restrictions have been fully lifted, and there's the potential for the UK and other economies to go into another lockdown. And so you're getting this roller coaster effect as far as economic activity and business activity is concerned. But at the same time, businesses are faced with higher levels of leverage. Not the all-time highs in leverage that came after the financial crisis, but definitely a fairly steep climb in levels of leverage versus what we were experiencing prior to the pandemic. And I think all of this then begs the question whether, not just for the UK, but for other major economies, whether it is sensible for central banks to be adjusting monetary policy at this juncture. So moving on to the next slide, and my view is that there's no need for central banks to rush. I think as far as the Bank of England is concerned, they've had interest rate policy on the floor for a considerable period of time. There were some modest interest rate increases in the back end of 2017 and through 2018. But realistically, I don't see there being the need for any tightening coming just yet. I think the Bank of England could wait until February, wait and gather more data with regard to the labour markets, with regard to the effects of any increase in restrictions on the UK's economic recovery. And more importantly as well, I think there will be a downshift in global economic activity that perhaps argues for a wait and see approach. As far as the US is concerned, this year has been predominantly about stimulus. It's been predominantly about fiscal as well as monetary stimulus. And again, the US is ratcheting back on the levels of asset purchases that they're making, but they're still in a monetary loosening mode, and they won't finish that until at the earliest the end of March of next year, but more likely into the second quarter, potentially as long as the end of the second quarter before they complete the asset purchase taper. And then that leaves them 6 months, but realistically it leaves them probably more like 4 or 5 months for them to put in place any monetary tightening. Now, they were very reluctant to withdraw the stimulus in 2021, and I think they'll be relatively reluctant to pull the trigger on monetary tightening in 2022. There are more headwinds that the US economy is likely to face in 2022 versus 2021, and also versus expectations that we were seeing really until recently. So in terms of raising interest rates in the US, I'm not convinced that we're going to see a significant movement on interest rates until we get towards the end of the third quarter. And then for Euroland, I think the European Central Bank have sat tight on monetary policy for all of this year, and that's been the correct stance. They've still been stimulating, they've still been making asset purchases. They accelerated those asset purchases at one stage. They've now slowed the pace of asset purchases again, but I don't see them completing their asset purchase program until the end of the first quarter of 2022. And I seriously doubt that there will be any hikes coming as far as the European Central Bank is concerned until 2023. Moving on to the next slide, looking at what's happening in the financial markets. Well, we've seen this, again, roller coaster in terms of risk appetite. So we started 2021 in buoyant mood, but actually, if you look at the performance of some of these asset markets, they haven't really gone that far. So we're broadly speaking in equity markets a little bit above where we were for some of the European markets, the FTSE 100 and the CAC 40. We're above where we were as far as the DAX 30, and in the US, the Dow Jones index has reached record highs only recently. But take a look at what this has meant for interest rate yields, and I've got gilt yields up here. You can see that you've seen this big spike in gilt yields around about October, November time, but then it's falling away. And I think this again demonstrates that risk appetite is relatively fragile, and the behaviors and confidence of markets would suggest that we're going to get greater volatility in risk markets, and that could feed in 2022 into the FX markets as well. So far from 2022 being an easy year to predict or call, I think 2022 is a year where we're going to see fairly sizable swings in both directions as far as risk appetite is concerned, and therefore asset markets. And that then leads me on to my final slide, which I want to take some time talking about, which is the FX markets, because our views have changed a little bit as far as FX markets are concerned. And I certainly think the risks around FX have altered fairly significantly. So for sterling dollar, as an example, we were previously predicting the high 130s throughout the remainder of 2021 and 2022. And now we're saying, well, actually, because of the moves that we've seen recently in sterling dollar, the risks are that we could be in the mid 130s over the course of the next sort of 3 to 6 months. Realistically, I think there are much more downside risks to sterling than there are upside risks against the US dollar. Yes, the US faces some headwinds, but so too does the UK. The Brexit issues may well continue to rumble on. The negotiations over the Northern Ireland Protocol continue without anything being agreed. Moreover, there are ongoing problems with regard to trade between the EU and the UK. So that could cause some problems for the UK going forward and could prompt some underperformance as far as sterling is concerned. So although the predictions are for sterling climbing against the US dollar, a lot of that is down to dollar weakness rather than sterling strength. And I think the risk is actually sterling may well underperform. Same thing for euro dollar. I mean, euro dollar has actually held up in recent sessions a little bit better than sterling dollar has. Sterling dollar is at risk of making new lows for the year, whereas euro dollar doesn't look the same sort of risk. And that's despite Europe obviously having to go through this process of restrictions and lockdowns because of the higher incidence of COVID infections. More importantly as well, I think that the euro economy in 2022 probably has more upside potential than the UK does. I think the headwinds facing the Euroland economy are lesser than those facing the UK. And so I think that we may well see euro dollar outperformance towards the back end of 2022. And that's the risk here, is that while sterling dollar potentially underperforms, euro dollar outperforms. And that's why I'm a little bit uncomfortable with the sterling euro forecast up into the 122s that we see within these forecasts. And the reason I'm uncomfortable with that is, think back to 2019, the peak there was under 121. Think then in early 2020, when we had the deal done by the UK government, the confidence that we had that would provide some sort of Brexit premium or dividend, well, actually, we didn't really see that. And again, the highs were just above 120 in sterling euro. So I find it difficult to imagine the circumstances that aren't already priced for by other markets, such as higher interest rates, that will propel sterling euro higher. And I think, again, the risks may be that we actually turn lower. I note today that we're below 117, for example, in sterling euro. So there are some challenges for sterling euro as we head towards the end of this year and into the first quarter of 2022. And then there are other currencies to take a look at as well. There's the potential for renewed weakness in the yen because of the problems associated with the new variant and low rates of vaccination in Japan. There are problems with regard to emerging markets as well. And we've seen issues around Turkey that continue to play out with a much weaker Turkish lira. We see the emerging market central banks having to ratchet up interest rates very aggressively in order to try and maintain stability and tackle the inflationary problems that they see within their economies. Will we see additional upside pressure on emerging market currencies, or will those pressures abate? I think that all revolves around what happens with inflation. If the inflation problems, if the supply chain disruption, if the labor market issues continue to reverberate around the global economy, I think that could put some pressure on emerging market currencies as we head through 2022. So that's been a relatively rapid fire look at 2021, a look back at 2021. And I think I'd just finish my piece by saying, we need to remind ourselves that there was an awful lot of complacency that crept in over sterling's upside potential when it rallied above 140 against the dollar and when it was in the 119s against the euro. I think we need to guard against that complacency in 2022. And certainly from a corporate perspective, there are going to be enough challenges as far as potentially higher inflation costs, higher wage settlements, and higher borrowing costs to tackle over 2022. The last thing that you really need to do is get the calls on currencies wrong. So caution is definitely the watchword. Volatility for markets is definitely the risk. And with that, after my disclaimer, I'll hand over to Piers and he can talk you through the technical look back at 2021 and a look ahead to 2022. But thank you very much. And Piers, over to you.
Well, thank you very much, Neil. Fascinating stuff as ever. I thought it's interesting looking now because we've had quite a lot of volatility and I was warning about that only last webinar. But if we go to the first slide, this is the dollar index. And I thought it's worth looking at this. This is the chart we had last month. And we were warning any weekly close above that 38.2 would see dollar strength come through. And we saw that strength come very quickly and that moved through. So if you see that sort of arrow there, like the beginning of Dad's Army in the old days, if you're old enough to remember that, that's pointing at the week that it broke through and closed above 38.2. So that led to dollar strength coming through there. And I just think at the moment, there's still a risk we could see this go up as high as 97, especially while 38.2 acts as support on any pullbacks lower. So I think it's it's an interesting stage for the dollar. It's just sort of pausing after having that first move up to the 50%, and it's slightly coming back. I think, where does it change? I think that's always the important thing. We know what sort of road we're on. Where does it change on the dollar? If you get back below 93.90 on a weekly close, then I think it'd be the first indication of dollar weakness. And that would be confirmed probably with a weekly close below 92.95 being where the dollar bulls have given up. But if we look at the next slide, this is a bit longer term picture, because Neil said, let's have a look into 2022. So let's look at the quarterly chart and see what's happening. Again, here, this is really significant, because if you look for the last sort of 6-7 years, you can see we've just been sideways in the dollar. And it's just stayed between 38.2% and 61.8%. And at the moment, we're at the worst possible place. We're mid the range, which is always the worst place, because when you're down near the bottom, it's been quite nice to say, look, the dollar should strengthen off this 38.2. As we get near the 61.8, you expect it to start to falter. But when you're mid, it's midway. You know, what's going to happen? So I think the thing here is, can it now do that move up towards 97 and 101? The last time it went up there, it spiked off and fell back down. So the market will sort of remember, look, last time we got up here, it fell off quite quickly. But it's really important to know those levels going into next year and just keep watching them on the quarterly basis, because when those two break, we should get some move. And I think what I've also added today, I've added on the next slide, I put on a very long-term picture outlook. So can we look at the next slide, please? That's it. So this is a quarterly chart, and it's showing the big picture going back a long time to 1980. And here you can see these massive swings of dollar strength that we used to get. Pre-financial crisis, this went down, then went up, then went down, was in long-term trends. And since the financial crisis, you can see that bit really, the first section where it just goes sideways in that little sort of triangle, the bottom sideways bit. And it just went sideways for about 5 years. Then it took a surge higher and got up to that 61.8% and the 38.2. And that's just traded sideways now for another sort of 5-6 years. So it really is a range-bound market without direction at the moment, which is unlike the dollar, because pre-financial crisis, the dollar always had a good direction, whereas now it seems to be a bit lost. And that's why it's so important to look next year and keep an eye on that 61.8 and 38.2, because when one of those two break, I think the move will be impulsive. So respect the trading range, be aware where the top is, be aware where the bottom is, and see if you get any signals in between. So that's the dollar index. So we've moved now to the next slide. We'll start to look at the currencies themselves. And we'll start with euro dollar. So this is the chart from October that I put in. And I was saying then, look for a move down to 112, 113 as a move down to that support zone. And if we look at the next slide, you can see we got that move down, and that's stalled quite nicely here at 112.40. So the levels are working really well. You know, a few quarters ago, we had that like engulfing candle, and that's led the way to it coming back down. And it's all been quite nice. But now the market has to decide, will much happen between now and Christmas? I don't know. The market's been in a downtrend all year on euro dollar, and it's had a target. It's reached that target. It's December. Would you want to put on new positions? Probably not. So I think that's one of the problems with euro dollar at the moment, why it's just sort of so caught sideways. And if there are any moves, I think it'd be more year-end tidying up rather than people putting on new positions. So on the next slide, let's try and look at the long-term picture. Let's look into 2022. And what are the risks? Well, here is a very long-term trend line in euro dollar. And this is going to be very important for dollar strength, you know, watching this. So at minimum, it's 4-point tested. And in point 2, there's quite a few tests. And in point 3, you could say there's a couple. In point 4, so you could say it's about 7 or 8 times tested trend line. But that trend line comes in 109 and 110. So that area is the real key area that the euro dollar bulls are going to have to protect. If they don't want to see this sink much lower, they need to protect that 109, 110 into the start of next year. The one thing on their side is you had a downtrend going through the dashed line coming down, and it could be a break higher and retest to that trend line. And that comes in the same area. So it's two reasons why you should see support. But you just have to be very vigilant that we don't break below that trend line, because you break below that trend line on a quarterly basis, and then you should see a lot of follow through where people who trend followers start to sell that aggressively. And if we look at the next chart or the next slide, here I'll put it is sort of like a triangle. It doesn't fit the triangle in short-term trading, which has to be short-term because it's too long, but it's that same basis on it. If you look at the two orange lines, we can see 120 is the top area, and we can see the bottom here is again 110. So you've probably got a sort of 110, 120 trading range to start going into next year. And be aware that if you break out that 120 to 110 trading range, things are changing. You break below 109 and start seeing 108, and the risk is 103.80 and 0.90 probably. But that's on a quarterly close basis, those breaks below and hold below. And to escape that risk, we need to see a good bounce off that trend line that we just saw on the previous chart. And you need to see price up in the 118, 120 and not falling off that area. It's important when it gets up to 118, 120, it holds that area, ready to try and push through that 120. So those are my thoughts on euro dollar at the moment. Sort of start with a 110, 120 range, but be aware outside that 10-cent range next year, something longer term is changing. So if we look at the next slide now, this is the sterling index. And I can't say enough how good I found this chart for every sterling-based currency, because we have the move down. I've shown this chart many times. Look how many times it stalled at the 38.2%. We have a strong uptrend, the orange dashed line underneath coming up, and that's trying to force the issue higher, trying to break it through this 38.2. But you need to see that break and close above that 38.2% before I get excited on sterling doing a large leap higher. Because I sat the other year in the dealing room and I heard so many people, every time there was Brexit news, oh yeah, the deal's done, there's a new government, Boris Johnson's in, Conservative landslide, and they were all forecasting this huge pickup in sterling. But what no one waited for was confirmation. And the rule of confirmation in everything in life is so big. And you need that close, quarterly close above 38.2 before I'd be saying, yes, now sterling goes. So we know where the upside break is. What about the downside? Now, the downside would be if we got a quarterly close below that dotted trend line going up. That would be your first indication. Hang on, maybe everyone's not so happy on sterling and people are going to sell it and have a go at the downside. So I think on dips at the moment, you really want to see it hold that 62.33 area. And if you get a close below 62.30, a quarterly close below 62.30, then you might find this is some sort of continuation pattern and sterling's going a lot lower. So always keep an eye on the sterling index. And if we go to the next slide, we'll see sterling dollar here. So sterling dollar, this was the chart we put on last month saying, look, you were above the 38.2 at the 134 area. If you got below that 134, it opened up 131 and potentially 129. And we've just gone into sort of 131s today. So that chart has worked well. The retracement breaking last month gave us a good clue that we're going down. Resistance on rallies should be in that 134 area. Need a monthly close back above there, clearly above there, to start getting a bit more positive on sterling dollar. And if we look at the next slide, this is the longer term that Neil wants to look at today. So this is a yearly chart. And there's one thing to put straight away to look at is the trend line going across the bottom. The black line from 85 coming up. And you can see that that's held every move lower. So that's held every move lower. You've got the 61.8% just above that, 124.5. So that's the real key area next year that should hold sterling dollar. And that's where sterling starts to change, sterling dollar. If you start to get below there, then it will wiped out all this move sideways. The one thing at the moment, it does look very negative because, well, it doesn't look very negative. It looks negative. Don't let me put words, too much emphasis on the very negative. It looks negative because if you go back about 5 years, that big red candle down, all the years since then, is 6 years actually. So if you look at the 5 candles since, they've all been contained in that one body. And to get positive on sterling dollar, you really need to see that candle broken and a close above there. Because the risk is, if it does come down below that black trend line, then it will be a continuation pattern on candlesticks and push for much lower levels. So where's the resistance on the upside? Well, this year you've been up to, surprise, surprise, 38.2% and fallen off there. So that 142 area that you can see there, that's a key area. And that's one of the reasons why sterling fell back off it earlier this year. So keep an eye on that. If we do see moves lower in sterling dollar, you want to see them based by 125, 123 area, basically. If you don't start to see some good impulsive bounce off that bigger picture, then it's a bit worrying. Where do you get confident on sterling dollar? You need the sterling index going through the 38.2, and you need to see it up above this 142, 38.2% retracement. So if we look at the next slide now, we'll sort of zoom in, because that's a yearly chart, very difficult to sort of plan on yearly charts. So this is a bit shorter term, quarterly chart. And again, we can see this is another thing that's not great for cable, is that the rally back up so far has stalled only at the first retracement, the 23.6. So it went up there once, fell off, it went for it again and fell off it again. So that 138, 142 is the buffer. And if you want stronger sterling dollar, you need to see that buffer taken out. And what you need to see is when it gets up there, price not falling off it, because every time it's got up there, quite quickly price is coming off. It spikes on it and it falls back lower. So where's the support? Well, the support at the moment, if we take the months, the quarters going across, I've drawn 2 back lines, you have a sort of base there. And so between that sort of 123 and 130, that should be a good support zone. And what you want to see is any moves into that start to get bought quickly if you want sterling dollar higher. If you don't see sterling dollar hurry out of that and bounce back up there, then it increases the risks of people keep testing the downside a bit more. So I would say on cable, on sterling dollar, just watch first of all sort of 129, 131, see that holds. Any monthly close below 128.5, I think that opens up the risk of a fall down towards 123.60. But if it can hold that 129, 131, then maybe a rally back up to test the resistance in the sort of 136, 138 area. And you want to see a sustained weekly close above 136 to start to escape this feeling that sterling dollar is always just getting pushed back lower. So if we look at the next slide, we go on to euro sterling. So I think euro sterling is very interesting. We've highlighted this for a few times that you seem to have a break and retest of the trend line. And so I'm going to leave exactly the same lines on there. We know the key level that needs to break. It is, surprise, surprise, 38.2%. It's held every move down since Brexit on euro sterling. So you need to get below 84. You want to see a monthly or quarterly close below that area, 84, to trigger a move down towards 82 and potentially 81 and 80. But you need that close below there. At the moment, it's provided support again, and it seems to be running back up. So what often happens is when you've broken the trend line, it then comes back again to retest it. So just be careful. This isn't a retest back up towards the trend line, and then it sells off. So it's just a case at the moment of watching. I put some levels on there, which you'll get when it's sent out, giving you sterling, euro, and euro sterling. The levels to watch, where resistance should come in, support should come in. And it's if each of those breaks, it will go to the next one. But where does it really change? I think that it probably changes on the top side. If you get a quarterly close above 91.10, then this whole attempt lower has probably failed, and you're going to see new highs in euro sterling or new lows in sterling euro. Where do you get positive? Below 38.2, you get positive that sterling's going to strengthen and the rate go lower. And, I hope these levels have helped looking at the markets, all the markets I've looked. I've tried to give big picture levels to watch. And the reason I've tried to give yearly as well, because this is the end of my contract, maybe the bank will renew, hopefully they'll renew, maybe they won't renew. But I just wanted to give you those in case it's my last webinar, the big levels to watch. But I'm pleased to say at the end of the year, we've hit all the targets we had, 112 euro dollar, 131 cable, and euro sterling respected that 84. So I think it's a nice note if it is the last one where to end up on. Anyway, I think that's it. If you have any questions, we try and cover a lot of ground in this webinar. And so if you do have questions, but you don't get through, or you want to ask anything on these currencies or any other currencies, send an email through to your NatWest salesperson and they can get in contact with me on your behalf. And maybe we can organise a call with them. Anyway, that's me over. Done. Is that the right time, Neil? Have I finished on time?
You have indeed, Piers. You've finished a couple of minutes early, so there we go. You've done well. Thank you very much for that. So it leaves me to bid you all farewell for 2021. We hope that these webinars have been useful and engaging, and we'd appreciate any feedback that you can give us. I'd like to wish you on behalf of myself and Piers a happy Christmas if you celebrate it. If you don't, happy holidays. And we look forward to speaking to you again in 2022, hopefully with Piers. I certainly think you've been a significant value add, Piers, so I'll be pushing for you to be back on these calls, if only to give me a further reality check or some light-hearted ribbing into the fundamental views. But to everybody on the call, thank you very much for joining us over the course of 2021, and we look forward to speaking to you in 2022. Thank you very much, and goodbye.